Hi, my name is Raven Williams. I'm a graduate student at Lamar University, and I major in accounting and finance. And this is my presentation for the financial statement analysis of 12 U.S. companies from 2019 to 2023. I also wanted to include my disclaimer from my report, and this is just to let you know that this is all for academic purposes and research. Everything that I've gathered from sources to charts and graphs, I've created them out of public sources and sites. And just again, this is coming from the comprehensive analysis of the balance sheet and financial positioning of 12 companies from 2019 to 2023. And this video is just supplemental to my academic report. So this is just my disclaimer once again. Okay, so before I begin, I wanted to focus on key objectives that made my project work. So for instance, the main objective was to evaluate trends from balance sheet, income statement, cash flow across the industries. Within my analysis, I focused on popular sectors such as energy, technology, healthcare, finance and consumer goods, and hospitality and entertainment. I focused on risk, profitability, capital structure, and sustainability. From this analysis, I observed that low-leverage companies like Texas Instruments and Home Depot displayed strong resilience, while high-leverage companies such as AMC and Occidental carried more risk. Cash flow and operational discipline emerged as key to long-term success. Limitations include reliance on historical data and differences in accounting standards across companies. First up, we have XOM, or ExxonMobil. Their sector is energy. They're oil and gas integrated. It's a large stock, or large value stock. The total number of employees, there are 62,000. Okay, I'm going to do my best to try to explain this as simple as I can. So we're going to go back to 2020. Like a lot of companies, Exxon got hit hard by the pandemic. Now the demand for oil dropped, and they took a massive $22 billion loss that year. So revenue fell to about $181 billion, and that's all the way down from $265 billion the year before, in 2019, of course. So then, that's when things got interesting. So Exxon bounced back fast. So by 2022, revenue shot up to $413 billion, and net income hit $55.7 billion. So even though things cooled down a bit in 2023, they still pulled $344 billion in revenue and $36 billion in profit. That's a pretty strong recovery. So from a profitability view, they really turned things around, and their profit margin went from negative in 2020 to over 10% by 2023. And their return on equity, which shows how well they're using shareholders' money, climbed to nearly 19%. Now, when it comes to debt, Exxon played it really smart. So they borrowed more money in 2020 to stay afloat than they did before. And right after they borrowed the money, they started paying their debt right now. Okay, so by 2023, their long-term debt had dropped from nearly $69 billion to $38 billion. And their debt-to-equity ratio also dropped to 0.20, so which basically means they're not overly reliant on borrowing. So on the investor side, Exxon offers a solid value, and their stock traded at about 18 times earnings, and they've got a dividend yield around 3.7. And you add in stock buybacks, and the total return to shareholders is over 5%. Pretty attractive, And finally, they're not just focused on oil. They are putting over $17 billion into cleaner energy projects like carbon capture and hydrogen. So they're really thinking ahead. And the bottom line is ExxonMobil is a great example of a company that took a tough hit and they made smart moves. And they really came out financially stronger. So now they're in a solid position in both terms of profitability and long-term strategy. Next up, I have Hewlett-Packard Enterprise, also known as HPE. This is the technology sector, and the industry is information technology services. It's a mid-cap value, and the total number of employees is 61,000. All right, so let's talk about HPE. So we all know it's a tech company, and they've gone through major shifts, moving from traditional hardware and becoming more of a service model and hybrid cloud solutions. So we're going to go back again towards 2020, around the pandemic. They also took a loss, or their revenue dipped around $26.9 billion. And they actually posted a net loss of $322 million that year. But since then, they've been steadily climbing back. So by 2023, revenue returned to about $29.1 billion, which is about right around their pre-pandemic level. And net income also came back up to $821 million in 2023. So what helped with that recovery? A big part of their recovery was their transition to recurring revenue, offering services rather than just selling equipment. And that brought more stability and better margins. So their profit margin went from negative to 2.8%. And their return on equity, while not huge, it's not that huge, but it rose to 3.8%. And that shows better efficiency in generating profits from their investments. And we take a look at their debt. So HPE had around $14.6 billion in long-term debt back in 2019, and that brought down to $12.3 billion by 2023. So their debt-to-equity ratio actually dropped from 0.73 to 0.57, which means that they're managing debt better and not over-leveraging. So while HPE isn't a flashy high-growth company, it shows signs of stability and steady progress. So they're not drowning in debt, they're actually becoming more profitable. And they've built a more predictable service-based business model, which is exactly what a tech company needs to survive long term. So overall, HPE is in a decent financial spot, and their transformation strategy seems to be working. My third company is Oxy, or Occidental Petroleum Corporation. The sector is energy. They focus in oil and gas production. It's a large value stock, and the total number of employees is 11,973. Now, Oxy had a pretty wild ride over the past few years, and in 2019 they made a huge move by acquiring Indarco for $55 billion. So that nearly dropped their asset base, but it was also a massive increase to their debt. So going into 2020, they were already heavily leveraged, and then the pandemic hit, so oil prices crashed, and Oxy took a serious hit. They posted a $14.8 billion net loss in 2020, and revenue dropped to just $13.4 billion. So their debt to equity ratio shot up to nearly 3.8, which is really high. So basically, they were in a risky financial position, but that didn't keep them down. So Oxy started making moves to fix their balance sheet. They slashed capital spending, focused on generating cash, and paid down debt. So by 2023, long-term debt had dropped from $38.5 billion to $17.8 billion. That's a 54% reduction. So their debt to equity ratio improved to 0.66, which is a big step in the right direction. On the income side of things, it also turned around too. So their revenue rebounded to over $30 billion in 22, then came down a little bit to $25.9 billion in 23. But their net income hit $9.1 billion last year. So that's a strong comeback from their losses in just a few years earlier. Profit margins also improved from deeply negative to about 35% in 2023. And return on equity was a solid 33%, which shows that they're using their capital pretty efficiently, at least when oil prices are strong. And the bottom line is, Oxy is still more risky than peers like Exxon or ConocoPhillips, mainly because of that acquisition debt. And they've made a lot of progress, and they've improved profitability, reduced debt, and now they have a little bit of breathing room. But still, because they're an oil company with a lot of debt, their success will always be tied to what's happening in global energy markets. The next company is SYY, or Cisco. It's a consumer goods sector. They involve food distribution. They're a large value stock, and they have 76,000 employees. All right, so we're going to take a look at Cisco, ticker symbol SYY. Cisco is the world's largest food distributor. They supply everything from restaurants to hospitals, schools, and hotels. And like most companies in the food and hospitality space, during COVID, everything was shut down and they took a big hit. So revenue dropped from $60.1 billion in 2019 to $52.9 billion in 2020, and they reported a net loss about $226 million. But since then, they bounced back impressively, and revenue climbed to $76.4 billion in 2023. And that's about a 44% increase from their 2020 low. And the net income also improved a lot, hitting $1.7 billion in 2023. So their profit margin rose from negative territory to 2.3%, and a return on equity jumped to 25%, which also shows strong efficiency in how they're using shareholders' money, right? On the debt side, Cisco has taken on a bit more leverage. Long-term debt rose from $8.9 billion in 2019 to $11 billion in 2023. But at the same time, total equity grew from $2.9 billion to $6.7 billion. And this also means that their debt to equity ratio actually improved. So from 2.2 down to 1.6, it's still on the high side, but trending, to the right direction. And what's also great is that their operating cash flow increased to $2.7 billion in 2023, which gives them flexibility to invest in tech, automation, and supply chain improvements. So what does this all mean? Cisco has shown a strong post-pandemic recovery. They're profitable again, they're generating cash, and strengthening their balance sheet. They're not without risk, especially if inflation or supply issues pop back up. But overall, Cisco is in a solid financial position and looks stable for the long term. This is ConocoPhillips, ticker sign COP. The sector is energy. The industry is oil and gas production. They're large value. They have over 9,400 employees. Since we're still in oil and gas or energy industry, let's talk about ConocoPhillips. So it's also one of the largest independent oil and gas companies, and its financial performance really shows how it's tied into its energy prices. So like most companies in the sector, COP took a big hit in 2020 when oil prices collapsed. Revenue dropped from $32.5 billion in 2019 just to hit $19.3 billion, and they posted a $2.7 billion net loss that year. But that made them come back even stronger in 2020. So revenue peaked at $70.3 billion, and that's more than triple the 2020 number. So in 2023, revenue dipped a bit to $56.5 billion as oil prices came back down, and they still managed to earn over $10 billion in net income. Their profitability also improved significantly to where their net margin reached 18.1% in 2023, and a return on equity held strong at 14.6%. So these numbers show COP is running efficiently and generating strong returns during favorable market conditions, right? On the debt side, They kept things conservative. Long-term debt was reduced to 13.9 billion by 2023, and total equity rose to nearly 70 billion. Their debt-to-equity ratio dropped to 0.20, which shows strong balance sheet discipline. And CFP has been great at generating cash, and their operating cash flow hit over 20 billion in 2023, which helped them reduce debt and return money to shareholders through buybacks and dividends, right? So here's the big picture. ConocoPhillips has done a great job managing through the ups and downs of the energy cycle. They keep their debt low, they generate a lot of cash, and they stay profitable when oil prices are strong. It's a well-run company with solid financial health, but like all energy producers, it's still heavily dependent on global oil market. Okay, so to change it up a little bit, I'm going to go into our healthcare sectors. I have HCA, also known as HCA Healthcare or Healthcare Assistant for Houston, right? They are a healthcare provider and service. They're a large value. They have over 294,000 employees. HCA is one of the largest for-profit hospitals operators in the U.S., and financially it's been pretty solid. So between 2019 and 2023, revenue grew steadily from 51 billion to 65 billion, which shows consistent demand for healthcare services, even though tough times like the pandemic were not as easy to deal with. At least financially, they were able to reap the benefits. And they've also been very profitable as far as net income that reached 4.7 billion in 2023, and their profit margins have stayed between 7% and 9% most years. One of the standout stats here is that the return on equity is about 198% in 2023, which is extremely high, but there's a reason for it. So it's not a catch, but it is a catch. So HCA runs on a very leveraged business, and their long-term debt sits at 36.6 billion, and their equity has dropped all the way down just to 2.4 billion. That gives them a debt-to-equity ratio of about 15.4, which is still huge. Basically, they're using a ton of borrowed money to fund operations and grow. Now, the good news is that they generate strong cash flow. So in 2023, they pulled in over 10 billion in operating cash, which helps them manage that debt and keep investing in new hospitals, equipment, and technology. So the key takeaway here is that HCA is profitable. It generates a lot of cash and has steady revenue, but it's also heavily leveraged, which means that it works well when business is strong, but there's a higher risk if things slow down. Overall, it's financially successful. The company, it does have a high risk, but it also has a high reward for capital. This is Texas Instruments, ticker sign TXN. It's in the tech sector. They are semiconductors as far as industry. It's a large value stock, and they have 35,000 employees. TXN is a major player in the semiconductor space, especially in analog and embedded chips that go into things like cars, industrial equipment, and electronics. So financially, they've been incredibly strong and consistent over the past few years. From 2019 to 2022, revenue climbed from 14.4 billion to 20 billion. So in 2023, it dipped a bit, just about 17.4 billion due to the slowdown in chip market, but that's still well above pre-pandemic levels. Now, here's where TXN really shines. Profitability. Their net profit margins was 37.4% in 2023, which is super high for any industry. And their return on equity, a solid 53.8%. That tells us that they're extremely efficient at turning investor money into a profit. Another strength is how conservative they are with debt. Their long-term debt stayed steady around 6.5 billion, and their debt-to-equity ratio actually dropped to 0.54 by 2023. So they're not overly leveraged, which lowers their financial risk. And they've also been investing heavily in their future. So capital expenditures jumped from 1.5 billion in 2020 to nearly 5 billion in 2023. So as they expanded their manufacturing capacity, it's a big move, and they're still maintain strong free cash flow. So what is the key takeaway here? TXN is a financially solid company. They're profitable. They're low in debt and investing for long-term growth. This is an investor's choice. So even with a dip in 2023, they're still one of the most reliable performers in the semiconductor industry. Next, we have PNC, which is PNC Financial Services Group. This is a bank institution. The sector is financials. They're a large value. They have 60,000 in total employees. So PNC is one of the largest recognized banks in the U.S., so they're pretty steady as far as finances go. Their revenue grew from 17.5 billion in 2019 to 20 billion in 2023. It's even peaked at 21.1 billion in 22, thanks to higher interest rates and the BBVA USA acquisition, which expanded their reach. So on the profit side, they hit 4.4 billion for net income in 2023, and that's a drop from previous years, but still, it's strong given the pressure banks face from rising rates, slow loan growth, and higher credit loss provisions. Their profit margin in 2023 was around 22%, and the return on equity came in at 9.3%, a respectable number for a bank. So now, what stands out about PNC is its conservative balance sheet. Their debt to equity ratio sits around 0.80, which is healthy for financial institutions. So they kept long-term debt stable, and they have strong capital buffers, which is important when navigating economic uncertainty. So PNC also generates, solid cash flow from operations, mainly from interest income and fees. So their total equity was about $53 billion in 2023, and total assets were over $557 billion. So they're well capitalized and diversified. Overall, PNC is a solid, low-risk bank. It's not flashy, but it's well managed financially. They're sound. They're capable of handling market shifts. I think that they're a stable performer in a sector that values reliability. So this is, a low-risk bank. It's very diversified, and I think overall it's not a bad bank to invest in. Next, we have the Hilton Group or Corporation, HLT. It's a consumer discretionary, involved in hotels, resorts, cruise lines. It's very large, and they hold 173 employees. Hilton, ticker symbol HLT, is one of the biggest hotel brands in the world. Their financial story over the past few years really reflect what the hospitality industry went through during and after the pandemic. And we're going to start with 2020. So I know that their revenue dropped more than half, from $9.5 billion in 2019 to just $4.3 billion, thanks to global travel shutdowns, and they reported a net loss of $720 million that year. But since then, Hilton has actually recovered in revenue, because they took a hit, $10.2 billion in 2023, which is actually higher than pre-COVID levels, while still maintaining a net income of $1.15 billion. So they're steadily showing that they've regained profitability. And one of the things that stand out is Hilton's business model. They operate on an asset-light strategy, which means that they don't own most of their hotels. They manage or franchise them, and this keeps their capital costs low and allows for quicker scaling. Because of this, their return on equity was impressive. They required a return on equity at 74.7% in 2023. But on the flip side, Hilton has a lot of debt. And I mean a lot of debt. So about $8.8 billion in long-term obligators, but only around $1.5 billion in equity. And that puts their debt to equity ratio at 5.8, which is high, but not unusual for hotel companies using an asset-light model. So the good news, their operating cash flow was strong. They have a $2 billion in 2023, which means they have plenty of cash to manage debt, invest in growth, and return value to shareholders. So to sum it up, Hilton took a big hit during the pandemic, but thanks to its franchise model and lean structure, it made a strong recovery. They're profitable again, they're generating cash, and positioned well for long-term growth in the global travel industry. AMC, also known as Movies and Entertainment, they have over 50,000 employees. AMC, as we all know, is a movie theater chain, and it's really been having a tough time since the pandemic. So they've taken a relatively large loss of $5.5 billion in 2019. They had revenue, $5.5 billion in 2019, and later it was just down to $1.2 billion. So theaters were closed, movies were delayed, and the whole business was on pause. So 2019 to 2020, those years alone, they lost $4.6 billion. So since then, they made a bit of a comeback. Revenue bounced back to $3.5 billion in 2023. But here's the thing: they're still not profitable, like hardly. And AMC reported a net loss of $900 million last year. And so that's 4 straight years of losses. Too much to be investing into. And their balance sheet, it's not in great shape either. So they've been carrying around $10 billion in debt, and their equity is actually negative. So about negative 60, my bad. that was too late. So negative $600 million, which means that their company owes more than it owes. That's in the rate. That means that their company owes more than it owns, which is a big red flag, for investors. And their return on equity was negative 139.9% in 2023, right? So to their credit, they've improved their cash flow slightly in 22 to 23. They've managed to generate some positive operating cash, around $212 million last year, but it's not enough to fully dig out their debt or turn consistent profits. So what's the takeaway? AMC is still in a financial distress. While they have seen a rebound in revenue and a little more cash is coming in, it's just not looking well. It's not looking too bright for them, and they're burdened by high debt and ongoing losses. So until they can consistently turn a profit and reduce that debt, they'll remain a high-risk investment. HD, also known as Home Depot, is a home improvement retail. They have 518,100 number of employees. So Home Depot is a home improvement space, and they're as strong and steady as wood can be. So even though they have economic ups and downs, or we as a collective have economic ups and downs, from 2019 to 2023, revenue steadily climbed from $110 billion to about $152.7 billion. So they hit their peak in 22 with $157.4 billion. They were thriving off of home renovations and DIY projects. So even though 2023 they dipped slightly in revenue, their performance still remained strong overall. Their net income in 23 was 15.1 billion, which is very impressive, and their profit margin stayed around 9.9%, showing consistent operational efficiency. The most interesting thing that Home Depot has going is their negative equity. Now, that's not because they're losing money, but because they've done so many stock buybacks. So basically, they returned so much cash to shareholders that it's reduced their book value. So despite this, their return on equity was off the charts. You know, it was over 15,000%. Crazy. But that's due to high profits and a low equity base from the buybacks. So their long-term debt has been pretty stable, hovering over 38 billion. Even with the negative equity, their strong earnings and massive cash flow is about 20.5 billion from operations in 2023, and they make debt very manageable. So what's the big picture? Home Depot is a rock solid company. They generate a lot of profit. They manage debt well. They reward shareholders aggressively. Their capital efficiency is top tier, and they've shown that they can weather different market conditions without missing a beat. Lastly, I have BKR, Baker Hughes. This is an energy sector. They focus on oil and gas, and they have 67,000 employees. Back to energy sources. Baker Hughes is a major player in the oil field service and energy technology space. In 2020, things got rough. Nearly to 10 billion net loss, mostly from write-downs and I guess write-offs and restructuring. So revenue dropped from 23.8 billion in 2019 to just under 20 billion by 2021. Since then, Baker Hughes has been making a steady comeback. So revenue hit 24.8 billion in 2023, which is the highest level in 5 years. So net income finally turned positive again, hitting 1 billion as their profit margin improved to 4%. They've been getting a lot better at than their earlier losses. So the return on equity also turned around from deep negatives in 2020 to 6.3% in 2023, and they're slowly rebuilding profitability and capital strength. So on the debt side, Baker Hughes has kept things pretty stable. Long-term debt hovered around 5.9 billion, and their equity has held steady at about 15.7 billion. So that gives them a debt to equity ratio of just about 38% or 0.38, right? Which is reasonable and shows controlled leverage. They've also managed to generate steady cash flow, 2.5 billion in operating cash in 2023, which gives them flexibility to invest in innovation and transition efforts like carbon capture and hydrogen. A lot like the other energy sectors and industries that I've mentioned before. But overall, Baker Hughes is recovering. It's actually in recovery mode, and they're not back to peak profitability yet. So they're still improving their margins, and they're trying desperately to keep debt under control, and they're focusing on cleaner energy tech. It's a cautious but encouraging financial comeback. Lastly, we have the top 4 companies that I recommend investing into. First up, we have Home Depot, ExxonMobil, Texas Instruments, and PNC. All of these companies make the cut of my analysis is because like Home Depot is super efficient with money. Even with negative equity, they made over 15 billion in profit. They have a strong cash flow, and they're great at giving money back to its investors. ExxonMobil, they had a big comeback after 2020. They made a $36 billion recovery last year. They paid down a lot of debt, and they're investing in clean energy. Texas Instruments, it's a solid and steady company. They had strong profits, they keep low debt, and even with a slow year for tech, they're still careful with their money and invest for the long run. Last but not least, I have ConocoPhillips, which also bounced back strong. They made over 10 billion. They keep their debt low, and they use cash to grow and pay investors. All 4 are financially strong, well managed, and built for long-term success. So if you're looking for long-term investments with essentially low risk but high reward, these are your 4 main companies to invest in. References, please feel free to check my work. All sources are public and they've been cited for. These derived from the 10K filings. And that is all. Alright, thank you for staying for my financial statement analysis. We're going to wrap it all up. This analysis showed how different companies manage their finances. They bounce back from challenges and plan for the future. As previously stated, the top performers were Home Depot, ExxonMobil, Texas Instruments, and ConocoPhillips. They all stood out for strong profits, smart debt decisions, and long-term thinking. And overall, this project helped me realize that whether it's through efficiency, innovation, or financial discipline, these companies are showing what it takes to stay strong in a changing economy. So thank you for listening.